Welcome everybody to Volatility Trading Strategies. So not a day goes by that I don't get at least one email in my inbox asking me how to add leverage to the VTS strategies to boost the rate of return. Now, I launched VTS over 8 years ago, so that's a lot of emails on this subject. And my standard answer is always the same. I don't use leverage in my trading, and I don't think anybody else should either. It's not necessary. I think if we structure our lives and our investments the right way, we can easily reach our long-term investing goals without the leverage, and without taking on excessive risk to chase those big gains. However, I have reluctantly decided to add some leveraged alternatives to the VTS strategies on my website. Just to be clear though, I still think people should stick to the standard strategies, but I just don't want people taking it into their own hands, going rogue and doing it wrong. So I will find some areas where I think adding a little bit of leverage might still be safe enough to implement. Before you do that though, and this applies to everybody out there whether you're interested in my strategies or not, please just watch this short video before adding leverage. Give me a chance to explain why I personally believe that for most investors out there, it's probably not worth the long-term risk. After you watch the video and heed my warnings, then of course do whatever you want. So subscribe to the channel, and if you want to support my work, just smash that like button for me. It's easy to do, but it really does help out the channel. So let's talk about leverage. So I'm going to cover several things in this video, but before we get into any specific examples, I just want you to ask yourself one very simple question. Why? Why are you considering adding leverage? This is step one, just being brutally honest with yourself about the psychology at play here, because there are some overtly dangerous reasons that people decide to take on leverage. Are you trying to play catch up because you started investing later in life and you want to accelerate things? If so, that's a bad reason and it's just asking for trouble. You can't rush the investing process. If you started later in life, then it is what it is. You just have to be patient, work harder, and save more money. Have you taken some losses recently and you're trying to make up for them by taking on additional risk to get it back? If so, again, this is dangerous. Trust me, the losses you've already taken pale in comparison to what could happen if you get reckless and try to get it back quickly through increasing your risk. Do you have unrealistic pipe dreams about being a full-time trader, and you feel a bigger leverage rate of return can get you there? Yes, I said pipe dream, and I stand by that. I've made 2 videos already talking about how unrealistic it is to be a full-time trader with no other source of income. The math simply doesn't work out when you're withdrawing money from a trading account to pay the bills. Negative compounding is very destructive, so don't do it. Those are just a few of the emotional reasons why traders find themselves taking on more leverage, but there's many more than that. Please be honest with yourself about the reasons why you're considering this. Understanding the psychology behind it can really help you make better decisions. But now let's get into the straight math of it. Many investors out there feel like adding leverage just boosts the rate of return, so why not do it, right? But remember, there is a flip side to that coin. It also means larger losses. You're amplifying things on both sides of the spectrum. This graphic is showing the rate of return required to fully recover from drawdowns of various sizes. You can see it clearly. Mathematically, losses are far more costly to a fund than gains are beneficial. If you take a standard trading strategy that suffers, say, a 20% drawdown, of course you won't be happy about it, but it's not the end of the world. It requires a subsequent 25% rate of return to get back to break even. With patience, that's doable in a reasonable time frame. But if you get aggressive, maybe that same strategy using leverage suffers a 60% drawdown. Well, now you're in trouble because it takes a subsequent 150% rate of return just to get back to break even. That might take a long time. And of course, then it also opens up the trader to the dangerous psychology of trying to take on even more risk to get that drawdown back. Things can spiral out of control quickly when traders take big drawdowns. My entire portfolio at VTS is based on the idea that the best offense is a good defense. It's not always sexy and it doesn't wow people on Twitter. But trust me, reducing drawdowns is by far the best way to increase your long-term rate of return. Always remember that quote, "Losses are more costly to a fund than gains are beneficial." Here's a real-world example showing the same thing. The blue line in this chart is showing the S&P 500 Total Return Index from January 2007 through March of 2020. That's over 13 years, and it covers the financial crisis in 2008 and the entire 10-year bull market since then. That red line is what it looks like if the investor took 3 times leverage positions in the S&P instead, something like UPRO or SPXL. You can clearly see what happens when you add leverage. The problem isn't the gains, it's the losses. Due to the big drawdown in 2008, the 3 times leveraged S&P crashed down far lower, and it took 10 years, all the way to the middle of 2017 to get back to the same level as the unleveraged S&P. It accelerated in 2017 because that was a good year for stocks, and then due to the Q4 2018 stock market crash, it dropped back down below. 2019 was another good year for stocks, so naturally the 3 times leverage went up a lot faster. But now here we are in 2020, we saw another big crash due to the recent health crisis, and yet again it's back down well below the unleveraged S&P. And of course, if this recession continues, or we see another crash in the next few years similar to 2008, maybe down 50% or so in the market, the 3 times leverage would go way below the unleveraged S&P again, probably taking another 10 years to recover. That is the risk of adding leverage that so few investors out there consider ahead of time. They think that adding leverage is always going to help, but that's just not true. There's plenty of situations out there where adding leverage makes things worse, and it could make things a lot worse. So the big question is, how do you know when adding leverage would be beneficial versus when it would just amplify those losses? This rather strange-looking chart is a hypothetical example comparing 2 traders over a 10-year period. Trader A is conservative, making consistent, slow progress month after month. Trader B is aggressive, and the monthly wins and losses are larger. And I've seen plenty of people posting numbers that look like this, 10 to 20% monthly in both directions, wins and losses. So you can see that both of these traders end up at pretty much the same place. They just go about it very differently. But now let's add some leverage. Starting with Trader A, because the results were consistent over time, it turns out to be beneficial in the long run. There aren't any major drawdowns happening, so it just boosts the performance over time. But what about doing the same leverage factor to Trader B? Well, now we clearly have a problem. Just like I showed before, losses are far more costly to a fund than gains are beneficial. Trader B was making forward progress, about equal to Trader A, but doing it with very large drawdowns along the way. So adding leverage to that means mathematically it's far more punishing, and it takes an exponentially larger rate of return to get back to break even every time it happens. In the long run, adding leverage to something that's already inconsistent is just a losing battle. So I'm not saying that you should or shouldn't add leverage. Of course, that's for you to decide. I just want you to see ahead of time what the risks are, and quite frankly, how bad the math can stack up against it in certain situations. Of course, in good times, when everything's going well, adding leverage just boosts the rate of return and everything's great. But no matter how good a strategy is, no matter how good of a trader you are, you will have periods that things don't go well. You, me, everybody out there will all have periods where the markets just don't cooperate. And if you leverage things up and those drawdowns do get too severe, that's when you can dig yourself a deep hole that might take a long time to get out of. My investing philosophy and how I design all the VTS strategies is the best way to get yourself out of a deep hole is to not fall into the hole in the first place. So if you like this type of analysis and you want to check out my daily blog, as well as all the live trade signals for all of my strategies, go ahead and claim your free trial on my website and see if the VTS community is right for you. You're always welcome. Thanks for watching. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.